What if you never owned anything again? What if the concept of property, the single greatest wealth builder for ordinary human beings, was quietly deleted? Imagine looking at your home, not as a place where your children will grow up, but as a subscription service, a monthly line item on your bank statement, paid to a faceless, borderless algorithm. This isn't a dystopian sci-fi movie. It is happening right now, in real time, in neighborhoods exactly like yours. While normal families are scrimping, saving, and sacrificing just to afford a down payment, a shadow titan is moving behind the curtain. BlackRock, the world's largest asset manager, holding an ungodly $10 trillion in capital, alongside Wall Street's elite institutional giants, is deploying a devastating strategy. They are weaponizing massive data infrastructure to outbid everyday families and turn entire neighborhoods into high-yield financial assets. They aren't just buying houses. They're quietly rewriting the rules of global human survival for profit. And if you think you can simply outwork them, well, you have no idea what you're actually up against. For generations, the economic engine of the middle class followed a predictable blueprint, the American dream. You buy a small starter home, build equity, and pass that generational wealth down to your kids. It was the ultimate ladder of upward mobility. But after the 2008 financial crisis, the rules of the game fundamentally fractured. Wall Street realized something dangerous. Distressed assets could be bought for pennies on the dollar. Initially, institutional giants bought up foreclosed properties in bulk. It was a cleanup operation. But then, the experiment worked too well. As we move through 2026, the landscape has reached a historic breaking point. Data reveals a terrifying reality. The percentage of entry-level housing inventory available to individual families has cratered to record-breaking lows. Why? Because institutional entities aren't just scavenging for leftovers anymore. They have pivoted to a highly aggressive, forward-looking offensive strategy. They are hunting in premium suburban markets, intentionally targeting the exact 3-bedroom, 2-bathroom starter homes that first-time homebuyers desperately need. Think about it. You find a perfect house. You offer 5% over asking price, stretching your budget to its absolute limit. You're thrilled. Then, out of nowhere, an all-cash offer comes in at 20% over asking, with zero contingencies, waiving inspection, closing in 48 hours. How can a school teacher or an accountant compete with that? They can't. And that is exactly the point. This isn't just an economic squeeze. It's a psychological reset. The system is systematically crushing the expectation of equity, nudging society toward a forced acceptance of the permanent renter lifestyle. You will own nothing, you will build no equity, and you will adapt to a life of perpetual financial vulnerability. But how are they doing this at a scale so vast that human realtors can't even keep up? The answer lies hidden deep within a digital matrix. To understand how a mega firm outmaneuvers a human home buyer, you have to realize you aren't fighting a person. You are fighting an ultra-advanced proprietary data engine. While the world focuses on public tools, institutional giants deploy hyper-advanced algorithmic frameworks. Let's call it the Algorithmic model, fused with predictive software like BlackRock's legendary Aladdin system. These enterprise platforms manage trillions of dollars across public and private markets. They don't wait for a home to hit Zillow. They don't wait for an open house. Instead, these platforms harvest real-time, hyper-local neighborhood data. They track local school ratings, shifting transit patterns, job growth metrics, and even foot traffic data from local retail hubs. The algorithm ingests this information, cross-references it with macroeconomic trends, and runs thousands of predictive pricing models in a split second to maximize potential institutional yield. The moment a property matches the high-yield profile, the system triggers automated, all-cash offers before the home ever sees a public market. It's high-frequency trading applied directly to the physical ground you walk on. This creates an utterly unfair advantage. Human buyers, constrained by mortgage pre-approvals, bank processing times, and emotional decision-making, are operating in slow motion. The algorithm operates at millisecond processing speeds. By the time you get the notification that a house is available, it has already been bought, processed, and cataloged into a global investment portfolio. Welcome to the absolute financialization of shelter. To Wall Street, a house is no longer a building made of timber, brick, and human memories. It is a line item. It is a bundled security traded on global markets alongside oil futures and tech stocks. And once an institutional giant controls an entire neighborhood, the rules of renting completely change. Have you ever tried to book an Uber during a rainstorm or buy a flight last minute? You watch the price skyrocket in real time. That is dynamic surge pricing. Now, imagine that exact same predatory software dictating your monthly rent. Using highly integrated, industry-wide data networks, corporate landlords analyze the exact scarcity of housing in a specific zip code. If options are low, the software automatically jacks up rent prices across the board. Is it collusion? Multiple state lawsuits and the U.S. Justice Department have aggressively targeted real estate software companies for alleged algorithm-driven rent fixing. But while the courts slowly grind away, your rent keeps climbing. And don't expect a friendly super to come fix your leaking sink. To squeeze every single cent of profit for global institutional shareholders, maintenance and property management are outsourced to completely automated, low-cost platforms. You don't have a landlord you can reason with when times get tough. You have an automated portal. If the algorithm detects a payment delay, it automatically initiates eviction protocols. No empathy, no nuance, just pure, unadulterated optimization. If you think this is just an American horror story, think again. This blueprint is expanding rapidly across the globe, giving rise to a borderless landlord class. From the suburban developments of the UK to the high-density districts of Europe and Asia, the philosophy remains terrifyingly uniform. In corporate boardrooms, they call it HaaS, housing as a service. Think about your life right now. You subscribe to Netflix for entertainment. You subscribe to Spotify for music. You subscribe to iCloud for storage. Wall Street's grand vision is to apply that exact recurring revenue logic to the absolute baseline of human survival, basic shelter. But there's a catastrophic asymmetry to this model. When you pay for a subscription, you build absolutely nothing. Every single rent check you write strips away generational wealth from the middle class and funnels it directly into the record-breaking dividends paid out to institutional investors. The wealthy get an appreciating, inflation-protected asset class. You get a receipt. Are we completely powerless? Are we rushing headfirst into a neo-feudal future where we are all corporate serfs? The year 2026 has become a critical battleground. The legislative landscape is finally waking up, but it might be a case of too little, too late. Historic measures like federal executive actions and the legislative push behind the 21st Century Road to Housing Act have attempted to slap a 350 home cap on institutional single-family landlords, trying to force Wall Street to divest. But our existing antitrust laws are fundamentally failing to slow down this consolidation. Wall Street has an army of lawyers and trillions in dry powder. If they are blocked from buying single-family homes directly, they simply pivot. They invest heavily in build-to-rent communities, buy up multi-family complexes, or underwrite massive private credit lines for smaller regional shell companies that do the buying for them. Yet, a ferocious grassroots resistance is exploding. Local communities are fighting back using the only weapon Wall Street can't easily buy: local zoning revolts. Neighborhoods are banning corporate single-family home ownership at the municipal level, declaring their communities off-limits to institutional capital. The window for individual home ownership is closing faster than ever before. This is a definitive race against time. Either local communities and historic legislative actions successfully reclaim the housing market, or the concept of the self-made homeowner becomes a relic of history. But there is one final, unsettling question that almost everyone misses. If Wall Street is building a trillion-dollar empire on the premise that you will rent forever, what happens if the market faces a massive, catastrophic correction? What happens if the giant bubble they've created finally pops? If you think Wall Street will lose, you don't know how the game is rigged. Because when the music stops, it won't be the institutional giants who end up on the street. It will be you. If you want to see how another corporate empire is secretly positioning itself to dominate the physical world, click on the next video and make sure to subscribe. Thank you for watching, and we'll see you in the next video.